We will continue with our onshore business. Our onshore business has grown significantly faster than we anticipated back in 2018 when we entered the US onshore market. We are a top 5 developer in the US, and we also recently acquired a European platform. So I'd like to welcome our CEO of our onshore business, Declan Flanagan from Chicago. Welcome, Declan.
Morning, Alan.
Declan, I'd like to ask you, how did the business come to where it is today, and how do you see us fulfill the ambition of reaching 17.5 gigawatt of capacity by 2030?
Yes, it's been a period of huge growth since our last Capital Markets Day, which came just a month after the formation of the business unit. And since then, we've been executing on our announced plan of a 5 gigawatt portfolio by 2025. I'm delighted to report we're on track to hit that target 3 years ahead of schedule, with a 4.7 gigawatt portfolio of operating or in construction projects by the end of this year. So 3 years into the business plan, we'll have made gross investments of some 35 billion DKK, creating a diverse portfolio of assets as measured by markets and technology. So now is a good time to revisit our ambition. And as introduced earlier by Mads, our new target is for a 17.5 gigawatt onshore business by the end of the decade. It's an ambitious but also a realistic target. It'll involve a run rate of approximately 1.5 gigawatts per annum, a pace of growth we have already achieved. It's a target backed by a development pipeline of over 10 gigawatts. So plenty of inventory, if you will, for the required pace of growth. So that's a quick snapshot of the business, Alan.
Thank you, Declan. A question we get a lot is around value creation. Value creation between onshore and between wind and solar, but also between US and Europe. So could you explain a little more our approach to capital allocation between technologies and markets?
Yeah, our expansion into solar is obviously one of the more significant portfolio choices we have made in the business, and also our expansion into non-US markets, as you mentioned. So I'll cover the thinking behind those choices. Also, I'm going to cover our thinking around the role of M&A versus our own Greenfield-driven growth. But first, let's start with what our customers want. And our customers want solar. At our last Capital Markets Day, we announced our first large solar and storage project, the Permian Energy Center, in response to the opportunity to serve an existing wind customer. And that pattern of customer behavior, buy wind first for price, then seek to fill out the portfolio with solar, is something we see more and more often. As a result, solar has made up 70% of recent corporate PPA demand in the US. And that's a trend we expect to continue. Most importantly, we've shown we can create value in solar. With 1.4 gigawatts of operating or in construction solar projects, we've achieved a spread to our cost of capital of 150 to 250 basis points. So very much in the strike zone. And I would note, and as Marianne will cover in more detail later, when we talk project returns, we mean fully loaded returns, accounting for G&A costs, project soft costs, etc. So simply put, our customers want solar. We create value supplying it to them. It's going to be a bigger part of the portfolio going forward. And we forecast our current mix of 70% wind, 30% solar evolves to an approximately equal share of wind and solar in the 2030 portfolio of 17.5 gigawatts. Now I'm going to go a layer deeper in the business now and explain via a project case study how being multi-technology, wind and solar, makes us a better and more efficient developer. The Helena Energy Center is a 518 megawatt wind-solar hybrid currently under construction in South Texas near the city of San Antonio. When Helena goes online next year, it will serve customers including Henkel, and Target Corporation. Now, in this business, access to transmission is often the scarce resource, and a 500 megawatt plus interconnection point close to load is especially so. But at this location, land use considerations and project footprint made a 500 megawatt wind farm unfeasible. But our development team was able to structure an optimized wind-solar hybrid that used the available transmission capacity, but also produced a more balanced production profile and generated strong economies of scale. So this hybrid approach is something you will see us do more often, both in terms of new build, but also in terms of infilling capacity at existing projects. For example, adding solar or storage to existing wind. And on the storage front, we have learned a lot from our recently commissioned 40 megawatt hour battery storage project at the Permian Energy Center. So this solar storage capacity infill is an interesting value lever going forward. Now let's shift the thinking to markets and geography. When we announced our ambition for the onshore business at the last Capital Markets Day, we're very clear on the global ambitions for the business. And with Europe and APAC scheduled to add up to 3 times the capacity the US will add by the end of the decade, the rationale is obvious. We've shown with our recent expansion into Europe, we can create value in global markets, again achieving spreads to our cost of capital very much in the strike zone. That being said, it's fair to say our recent entry into Ireland and the UK was at the lower end of our range, as one would expect with the entry price element of a platform deal like that. But we're confident we can expand margins over time as we accelerate growth of the platform, as we did with Lincoln Clean Energy. We also feel that the highly contracted cash flows and simpler capital structures are a nice complement in the European portfolio, are a nice complement to our overall portfolio. All that being said, the US will remain our core market, and its combination of scale and overall risk return mean it will attract the lion's share of investment during the planned period, and we forecast that the US will make up 80% of the 2030 portfolio of 17.5 gigawatts. So Europe is another example of us being a good buyer and M&A being part of our growth plans. But what makes us a good buyer? I'll focus on 2 things. Our proprietary deal flow and our ability to move quite quickly where we find a deal that fits. On deal flow, we have a deep network in the US and globally, and it means we see a lot of opportunities. And the majority of what we've done in M&A has come from our proprietary network. As regards moving fast, our funding model, lack of reliance on project finance, and our ability to take and to manage merchant risk allow us to move fast where a deal is the right one for us, and also create extra value. For example, by buying a project at late stage development but without a PPA and securing a PPA later and enhancing the business case. In fact, just last week we announced a perfect example of that with a PPA with a group of municipal utilities in the Midwest US served by one of our wind farms in that region. So M&A has been and can be in the future an important part of the growth plan, but our core competence is very much greenfield development, and that is where the majority of our projects to date have come from. But what makes a good greenfield developer? As we like to say in the business, it takes a village to develop a power project. But the core skill when it comes to development is what we call development ground game. And that means managing and understanding all stakeholders, and especially our landowners. So now we've got a short video to show you, which is a great illustration of working with landowners on our projects.
I can't tell you how many times we just got wiped out. We would lose a crop because of wind blowing. And, you know, now we're getting paid for the wind to blow.
As far as the landowners, just having the income, you know, it may be the difference of somebody staying in farming or not staying in farming. If they stay in farming, that's something they can pass down to their kids. Just the extra income is just positive.
You know, they may not be for everyone, but the company's easy to work with. The impact to the environment is very little, and I think farmers and ranchers are some of the best stewards of the land. We have to be, because they're not making any more.
You can still farm around the windmills, you can still run cattle around the windmills. If it's in a government program, it doesn't affect that. Basically, it gives you some roads, which in our pastures we love, because we can go check our cattle with new roads that go to the windmills that we didn't have before.
Even the people that don't have turbines, like I say, they're getting a new school building. There's a lot of new school buildings that have happened after the turbines. I've tried to take care of what land we have, but this seems like a pretty good way to generate electricity to me. It doesn't pollute. We're not damming any rivers. We're not burning coal. This sounds like a really good idea. Use the wind.
That is a good video that I think also demonstrates how we strive to be good neighbors in the communities we operate in. But let's continue with the presentation, Declan. With the increased competition, how does that impact our ability to secure good off-take contracts?
Yes, it's very much a business about contracted revenue, and in our existing portfolio, we have 90% contracted revenue and with over 10 years of remaining contract life. It's very much a portfolio approach to offtake with a range of customers from utility, financial, government-backed, and of course, corporate offtake. So let me focus on corporate offtake for a moment. And as you mentioned, Alan, it is a competitive market. And next to transmission that I mentioned earlier, good quality offtake is the scarce resource in this business. So I'm particularly pleased with our track record in the corporate offtake market in recent years, where we've been able to both increase our average price and also increase the duration of our contracts. But more importantly, we very much focus on continuous improvement in the contract terms and adding new improvements such as upside sharing mechanisms or downside mitigation. So we now have what I feel is a more balanced share of risk between buyer and seller than perhaps was common in the corporate part of the market just a few years ago. And that, of course, is a natural evolution of this new market, but also reflects the fact you have so many more corporate buyers at scale in the market than just a few years ago. So great progress on contracted cash flow, but managing the merchant component of the portfolio is also really important. And earlier in this year, we made an organizational change to bring the US trading team within the onshore business unit, and that's working really well. So we have close coordination between teams working on long-term contracts and those trading in the real-time markets, and that makes us better at both. So that change has worked out really well.
Declan, we often hear the onshore market being described as a more commoditized market compared to, for example, our offshore business. So how do we stay competitive and create value in a more commoditized onshore market?
Well, I always like to start the competitive advantage question, Alan, with a nod to our track record to date. And the momentum we have built has shown we've got something going for us. But as we look to execute the plan we're announcing today, I think of 4 pillars of our competitive advantage. Number 1, Greenfield development culture. This is a group and a business unit where the Greenfield heritage is really strong. And that ability to take and to manage well thought out development risk is really important. Number two, our global scale makes us a preferred partner, whether it's equipment manufacturers, global corporate customers, or in the case of the US market, with the largest tax equity investors. That global scale and being a preferred partner is a big advantage. Number three, our funding model and our ability to take and to manage some level of merchant exposure allows us to take a portfolio approach to growing the business and to move with a pace that is better than a lot of our competitors. And finally, number four, our global employer brand. We've shown we can attract the best talent in the US market as we've scaled the onshore business there, and we're starting to see that in Europe also. And of course, these four things become self-reinforcing. Focus and purpose attracts the best talent, which manages the risks, which creates growth momentum. As I begin my wrap up here, Alan, I'm just going to focus on that word, momentum. We're entering a decade where the energy transition is just going to accelerate, and we now have the momentum in the business unit to play a significant role in the onshore segment of that energy transition. The US is going to remain our core focus, but we will remain globally ambitious while always being patient. We have the Greenfield development culture to ensure we can create value across the portfolio. We have the talent and the organization in place, both within the business unit and the integration with the capabilities of the broader organization. And whether it's US tax equity, global corporate engagement, or business development opportunities in APAC, our onshore and offshore teams are working together every day. So it's an ambitious plan, but we have the momentum to achieve it.
And so over to you, Alan.
Thank you so much, Declan. It's certainly going to be a busy decade within our onshore business as well.